Railroads weren't transportation in the 1870s. They were collateral. America financed tracks like they were already finished. Railroad bonds sold a future that didn't exist yet, and everyone treated the paper as if it could always be sold again. The projects took years. The funding depended on the next placement. Then J. Cook and Company couldn't place the bonds. That wasn't one firm failed. That was the dealer going quiet. If the bonds don't move, construction stalls. If construction stalls, the interest payments stop looking inevitable. And the moment that promise wobbles, the safe asset becomes a question. The first thing that breaks isn't the tracks, it's credit. Once lenders doubt tomorrow, terms change fast. Cash gets demanded. Time gets shortened. And when everyone reaches for cash at the same moment, the market stops behaving like a market and starts behaving like settlement. That's why the New York Stock Exchange closes. Not for drama, because clearing is failing. You can always make trades. Completing them is the part that breaks when trust is gone. Banks start rationing withdrawals. Payments slow. The economy tightens because every link is waiting on the one before it. And with no central bank, stabilization looks like improvisation. The New York Clearing House issues loan certificates so banks can settle without draining cash. The Treasury pushes liquidity by buying bonds and releasing currency. It doesn't fix the railroads. It stops the spiral from becoming total shutdown. But even contained, control still moves. Railroads go into receivership. Creditors write the terms. Expansion stops. Workers disappear. The shock spreads through suppliers and towns built on the promise of rails. The Panic of 1873 wasn't only a crash, it was a transfer. From builders to bondholders, from growth to liquidation, from whoever needed money to whoever still had it. Assets can survive, funding can't. And when long projects are financed with short money, the ending isn't gradual, it's scheduled.